All right. Recap. We just finished our interview with Ted Whitehead from Arrow. What is it?
Arrow Asset Management.
Arrow
I
Asset
think
Management. I should have known that. I didn't have my notes here. But
Arrow.
yeah, it was interesting, I thought, because it was I mentioned in the intro, as you'll see, we brought somebody on that has pretty much the exact same view as Ben as far as the investing is concerned. So it's the first time we've really done that. So it was them, kind of just hugging it out the whole time, just kumbaya, sitting around the campfire, smoking the peace pipe. But there was a lot of good points in there too. Ben, why don't you hit some of the highlights?
Yeah, no, I mean, I thought it was great, super interesting. I mean, Ted's had a successful career, which he talks about, starting in kind of small caps and kind of moving his way along. The thing that was interesting is that, a lot of those things are similar. I grew up thinking around valuations, as did he, and kind of migrated into kind of thinking around a different way with a similar objective I've always had. And I've said to people, is my objective is to make you money in all markets. And so it's a unique proposition because people don't think that way. And so, Ted kind of had that similar philosophy that he thought around it. This the product that he has, the exemplar growth and income, is really a unique offering in Canada. And he invests his money this way, where he wants it to grow consistently. He doesn't want the wild swings that you see owning a typical equity only fund, where you'd be down 40% last year, where his fund was slightly positive. And so really kind of that philosophy was very interesting. The other thing which we just talked about was when I asked him a question around valuations and does that matter, and the answer, where he didn't say it exactly that way, but basically he said, valuations aren't what they used to be.
Yeah.
And ultimately our objective, right?
Yeah.
And ultimately he said the objective is let's make money.
Yeah.
The objective is to make sure we make money for you.
Yeah, exactly. Okay, well, if you want to dig into that further, we have an hour of that, or if you just want to watch an hour of Ben and Ted's bromance, stay tuned for the in-depth macro interview. All right, welcome to another episode of Think Heart. I'm Scott Goodfellow. This is Ben Hart, as usual. We're the Hart Investment Group. Another exciting interview today, Ben.
Yep.
Normally, we're not afraid to bring on controversial people. We're not afraid to bring on people with contrarian views to our own as far as investing is concerned. Today's not one of those days, right? This is, when you told me about a little bit about Ted and, kind of his philosophy and, it sounded very much in alignment with yours. So I don't know if this is going to be an hour of patty cake between you two, but we'll see. We'll see what we get. I like to bring on the controversial ones and just serve up the topics and watch you go at it. But I think this one will be
for sure.
And I'm mostly kidding, but I think this will be a good one because I think you'll be able to play off each other nicely. So without further ado, Ben, why don't you introduce our guest?
Awesome. Yeah. Thanks very much. Yeah, so I'm excited to have Ted Whitehead here. Ted runs the Exemplar Growth and Income Fund. Part of my initial interest around it was, a couple of years ago, I started following Keith McCullough at Hedgeye, and then I realized that Ted incorporates a number of those things into his philosophy and view. So I'm really excited. I talk about, obviously, Scott and we talk about the quads and talk about how those work into the world, and we have these conversations with clients, and so I'm excited to hear what Ted thinks, how he interprets it, how you adjust, how you make decisions. It's really kind of the first person I've had the chance to have kind of a conversation where we're talking maybe potentially similar language. So I'm excited to invite Ted here tonight and have a good conversation about macro in the world. And he's having an excellent year this year as well. So I'm looking forward to having a good discussion. So Ted, maybe you can introduce yourself a little bit, and first off, maybe you can tell me about how you got interested in investing.
Sure. Thanks, Ben. Thanks for having me on the show. How did I get interested in investing? I had a brother-in-law who was part of First Marathon.
Okay.
And it always seemed like whenever I went over to my sister's house, they were doing pretty well. And growing up, my dad always played the stock market, and he hit it big on one stock, and we were able to buy a piece of property. So I guess just being around it.
Mm-hmm.
But again, when I went to university, I really just went to take business. I didn't know this is where I'd end up.
Right on. Yeah, that's I fortunately had a number of conversations. And I think it's usually some kind of family connection brings you to the world of investing. So that's
hey Ted, did you know that?
great.
Did you know that Ben and I are brother-in-laws?
No, I did not know that.
Yeah, Ben's married to my sister. Very similar situation. I go over his house, he razzle-dazzle me, and then here we are.
Yeah, exactly. Long story short.
Yeah, we'll tell you the rest later.
Yeah, exactly. So go to business school and then decide you want to get into the investment business. What's the next step? What's your first foot in the door?
Well, my first job was, I don't know if you remember, there was these things called corporate cards at the Financial Post. Mm-hmm. And I wrote the mining and energy cards.
Okay.
So Dome Petroleum, Dome Mines, stuff like that back in the mid to late 80s.
Yeah.
And then again, I looked around the office and said, who's the guy that makes the money here? It's the guy that sells the product.
Yeah.
So I had a friend who worked at Walwyn, Stodgill, Cochrane, Murray on the bond desk. So he got me in as a broker, an investment advisor.
Okay.
Back in February 1987.
Wow, good timing.
It was, because all that prospecting I did from February through till September, it paid off in October.
I bet.
Here I was under my desk on October 19th, 1987, and clients were starting to call me and saying, I want to buy CP. Yesterday it was 30, now it's 14.
Yeah.
So that's how I started, and then from there I wanted to be a bigger fish.
Yeah.
So I went to RBC and did 2 years there and built up an options trading business.
Okay.
And so I wanted to be more of a trader. So I left. I went to Credit Suisse for 7 years. Mm-hmm. And we were given $1 million of capital to trade. But it was mostly executing orders, not very different from being at, say, TD Greenline.
Okay.
So I started working on my CFA, and Credit Suisse in Canada was shutting down. And so I applied at Elliott & Page, which was part of Manulife. Mm-hmm. And lo and behold, when I go to the interview, the guy who I'd be working for, I used to always sit beside at these corporate lunches.
Okay.
I never knew his name, but we always kind of got stuck sitting beside each other. And so that was a slam dunk, I guess. And so Elliott & Page was Manulife.
Mm-hmm. Yeah.
He was a value manager, and I came on as the trader.
Okay.
And we had 3 analysts as well. And because it was value in 2000 or 1999, he wasn't a buyer of Nortel, right?
Tough time.
So the index was up, I think, 35%. We were up 12.
Yeah.
And so they dispersed the money, and we had a small cap funds of 10 or 20 million. And no one wanted that. And so they asked me, I said, sure. Yeah. And at Manulife, I grew that 20 million to 1.8 billion at the top.
Wow, fantastic.
Wow.
Amazing. That's good.
People interested.
Yeah.
In the beginning, it was hard to get people interested.
I'm sure.
An unknown quantity, and the 5 years before, small caps were in the doghouse, right, from 95 to 2000.
Yeah. Yeah. Well, first, before we go on there, I would like to know what it was like in '87, October '87, what that day was like when the market just cratered, when there was no bid. Like, what was that day like?
Well, I think no one had seen that.
Yeah,
Now we've seen it a few times.
sure. Yeah,
But
exactly.
back then, I think it was pretty shocking, and
Yeah,
like there was no one to turn to for advice.
sure.
Because the last time really something like that happened, I guess, was 1929.
Sure.
Whereas now, if you came to me, I'd say, well, it happened in 87,
Yeah,
happened in 2000,
yeah,
happened in '08,
yeah,
happened in 2020.
yeah, yeah, yeah.
No, I'm experienced.
Yeah, exactly. You got some scars.
Yeah.
You know how to do it. So yeah, so you take over a small cap fund and then you grow it to 1.8 billion. That's a huge success. And then you decide to make a change at that point.
Yeah, so I was at Manulife until 2018, early 2018.
Hmm.
And I guess I retired.
Yeah.
I was forced to retire.
Okay.
But it was amicable, and I guess I was ready to leave there.
Hmm.
I'd been there 22 years and running money there for 20 years.
Yeah.
So I sat at home for about 2 months, not even. My last day was really February 28th of 2018, and I
Okay.
started April 1st at Arrow Capital.
Yeah. Yeah.
And
Excellent.
so I wanted to come back and run a product where you could try to make money all the time.
Yeah.
As you know, if you buy an equity fund or get involved in equities, if the market goes down 20%, a good fund goes down, say 15,
Yeah.
and a bad fund goes down more than 25.
Yeah.
Bad fund, I mean, it depends on what they're trying to accomplish.
Yeah. Yeah. Of course.
But I wanted to run a product where, you have the capability to move around and make money in all environments.
Yeah.
And I think that's what we try to do here.
Yeah. So it's a pretty big change from running small cap money. Obviously, small cap, you're looking for high growth, which tends to lead to a bit more risk and more volatility, than shifting into kind of make money in all markets. So, what brought you to that, and then maybe you can give me your thoughts around when you started to talk to Keith and kind of follow kind of the macro process that they use.
Yeah. So when I started managing money, we were quant.
Okay.
So the value guy, he kind of lost the battle, and the US guy was a quant, and so everyone had to become a quant. And so in small cap land in Canada, estimate revisions, earning surprise, and price momentum, that works.
Okay.
And there's a lot of inefficiencies in the small cap market. So
Sure.
I would say it worked so well that in 2010, they gave me an all cap fund. And so we got involved in foreign markets and part of a balanced fund as well. So
Okay.
again, under both regimes, my compound return for both was around 10.5% for the time that I ran those funds.
Excellent. Excellent. Okay.
So
So
here, yeah.
so
So
you've all,
here,
go
sorry.
ahead. Ed. Go ahead. Go ahead.
Well, I was just going to say that, again, I wanted to do something different. I didn't want to just be an equity guy.
Yep. And so you've always kind of had the quant view, I guess, is what you're saying. You've had that kind of top-down look on things, and so so maybe tell me about you got to construct your own fund however you wanted. Tell me what the thinking around that looks like, and is it truly a go anywhere, do anything mandate? Tell me a little bit about how your thinking got when you created this.
Yeah, so when I came on board, it already had a 3-year track record, but the assets were small. So this is the growth and income fund
Yep.
at Arrow. The assets were around 25 or 26 million. So again, it sounded very familiar to my other story.
Yeah.
Here's a chance to grow something bigger.
Yeah.
And initially, So it's a macro shop. So it's a top down, where I came from a bottom up. You know, you try to buy stocks with good characteristics rather than what's happening with the economy and where sectors or where do you want to allocate your money. So different. And so
Sure.
they had been using Keith or Hedgeye since about 2016.
Okay. Okay.
And I guess why I warmed up to it is, as you know, everything's mathematical.
Yes.
So there is it's a real process, not I think maybe like there's not a lot of guessing work. It's kind of like, so when I was younger, one of the things I loved to do was play poker.
Yeah.
So again, I kind of view the way he does things as like Texas Hold'em. You know, you get your first two cards, and that's a little bit of information, and then you see the flop,
Yeah.
and then you have a little more information. You can see a little further out and make a better bet, and then the turn, you know, and then the river. So little pieces of information keeps coming out over time, and that's really the way they look at things.
Sure.
And based on how that information comes out, you can make a pretty good determination of how things will play out.
Yeah. Yeah. Yeah, so it's an extremely unique style and strategy to think around that. You know, it's much more evolution and moving, quite a bit more action than you might have in a typical strategy, which is more aligned with, I'd say, you know, as you say, buy good companies and, you know, over the long term, they'll outperform the index. This is adjust on the fly, so to speak. It's adjusting to the macro signals that you're getting. And, you know, that's a challenging because macro has been difficult historically to predict, right? Short-term macro.
Yeah, it has. I guess I never knew that. Because I never really looked at it that way before. And
Right.
then here, I would say he's very good, but he can be very wrong at times too.
Sure.
So you need more than just one outfit to follow. You have to look for other pieces to backfill.
Yeah. So maybe you can describe a little bit to me how you think about portfolio construction then, and when you're thinking about, obviously there's many moving parts, so you know you start with where would you start? Maybe I'll leave it to that, and then you can tell me before I put words in your mouth.
Yeah, so I think Hedgeye has a very good framework, and again, it's not new. Ray Dalio started this in 1985. And he keeps the framework's fairly simple, right? You want to know what's happening with inflation and what's happening with GDP growth. Yeah. So essentially, the way I look at it is, if GDP growth is accelerating, then you want to be overweight equities.
Yep.
And if it's decelerating, then you want to be overweight bonds.
Yep.
And then on the inflation, that's where you get more nitty gritty on the sector allocations. Is when you have inflation accelerating, it's generally the value or cyclical type names like energy, materials, financials, industrials. And then when you have deceleration, it's more the defensives, healthcare, staples, utilities, and REITs. Yeah. And technology tends to work in all time frames except when you have both going down, both decelerating growth and inflation.
Yeah, yeah.
So again, it's you just have to determine those two factors, and then you can start populating.
Right, right.
Yeah, so we've been coming off for the last 4 quarters. It's been both accelerating inflation with accelerating growth. Yeah, and so you've wanted to have that value cyclical trade on, and be as much in equities as you can.
Yeah, yeah. Yeah, and so we've seen that play out here. We've seen commodities rip, and we've seen financials rip. You've seen, as you say, all those asset classes do well. And now it feels like maybe something a little bit different is happening. Is that your interpretation of what you're seeing today?
Yeah, so again, using the numbers from Hedgeye, peak GDP and CPI are likely in the second quarter, but there's probably still good numbers to come out in July. So we haven't transitioned to being like totally defensive.
Right.
And well, I heard him this week. He doesn't really believe it's going to be a typical quad four.
Right.
And I don't really know if there is really a word for typical quad four. The two that have stood out are like the fourth quarter of 2018
Yeah.
and the second quarter of last year.
Yeah.
But if you look at that, what really makes a quad four, or what really brings down the market, it's interest rates going up. So in the fall of 2018, you had Powell raising rates, and he did it that one time too many in December of 2018, and all the market just went free fall. But it already started in October, and then last year it was more of an event.
Yes.
So I know someone's predicting Yellowstone's going to explode in July, but you know that's kind of like a COVID thing. Like if there's an event, it's not really that predictable. But at least with the COVID, you were getting a heads up as to what was going on in China, and oil prices plummeted about $8 in 1 week.
Yeah,
and you know the odds are that that was going to come, like the COVID was going to come to North America.
Sure.
So we got very defensive, and that's what we did in 2018 as well.
Yeah, yeah. So when you talk about getting defensive with your portfolio, just what would you do from that perspective? What would you be looking at from a shifting? How would you be shifting the portfolio, and how aggressive do you typically shift that when you do that? What would it look like?
Well, in a quad four, when you have both decelerating, you typically want to raise your long bonds. So both in 2020 and 2018, we had between 40 and 50% in 20-year treasuries.
Wow. Okay. Yeah.
So we were prepared, and then we were down to like 20% in equity, and the equities were predominant. I wouldn't say there was any sector we were zero.
Sure.
But they're predominantly the defensive names.
Okay. Okay.
The utilities was 8%.
Okay.
And this fund, we're allowed to go 20% short. So we had the inverse ETFs as well.
Okay. So do you yeah, go ahead.
I was just going to say, if you ask us how we're positioned now, it's still kind of balanced. We're around 34% in, I guess, what you'd call cyclical names, 5% in commodities, 20% in bonds, of which half is the long treasuries. And we have about 5.5% in utilities. And I was just trying to check, what my beta is, but it's probably around 1.
Around 1. Okay. Yeah. Yeah. Well, it gives some indication for how you're thinking and what you're thinking about. When you're using the inverse ETFs, do you ever use options to structure the portfolio, like for defense, or is it always like what are the constraints that you have?
Yeah, we used options, and in December of 2018, believe it or not, I had calls on the QID, like the double time NASDAQ.
Yeah. Nice.
The double short NASDAQ, I had calls, which is like, maybe that was a bit too aggressive,
but it worked.
But it worked.
Yeah. So obviously you invest money for Canadians primarily. So what's the challenge? A lot of the positions have to be U.S. international in nature. What do you do from a currency perspective? Does this come into your thinking?
Yeah. So we look at, I guess, cash, bonds, equities, cash, bonds, equities, currencies. I'm sure there's one more. I thought there was 5. Oh yeah, commodities.
Yep.
So those are what we view as our asset classes.
Okay.
And generally speaking, it's between Canada and US dollar.
Mm-hmm.
Although we have about 7 and change in foreign currencies now.
Okay. It's pretty high.
Yeah.
Yeah. So do you hedge the Canada US sometimes then as part of the process?
Yeah. But
Yeah.
currently we're 31.25% US dollars.
Okay. Okay. That's a bit with your view, I guess, that it's potential that we get growth and inflation slowing at the same time. US dollar should do
Right.
well. Yeah.
Right.
Okay. Yeah. So what do you think about, what you see ahead of the world? Obviously, some of this is macro. Do you think out past a quarter or two at a time when you're putting things together? Or how do you think about what's happening on a day-to-day basis right now?
Yeah, I would say we are always trying to position 1 to 2 quarters out,
Okay.
but no further,
Yeah.
and really stay focused on the signals of the day.
Right.
And I think that's really the key. So it's easy. So again, I would say getting back to the inflation and growth,
Yeah.
that's not new.
Right.
The street knows that story. The rate of change year over year.
Yeah.
It's what is everybody looking at as far as the signals.
Right.
So again, getting back to last year, the key was oil rolling over in such a quick fashion.
Yeah.
And then you put 1 and 1 together, and it's China's the second largest economy.
Yeah.
And if they had 750 million people on lockdown,
Yeah.
something's going on.
Yeah.
And then the US dollar started to go up, and bonds were, getting a little more bid, but it wasn't really aggressive at the beginning. But then in early March, it just, those yields collapsed.
Yeah. Yeah.
So other things you can look at for is like the VIX. So right now the VIX has been tame. It was as low as 14 something today and closed just under 16.
Yeah.
When it gets too low, it usually pops up. So it could be due for some kind of pullback going into the quarter end.
Yeah.
But under 20, I think you want to be long equities.
Stocks. Yeah. Yeah. So no, that's a good point. So you say that inflation and growth is important, but there's signals. What other signals besides VIX would you look at? Obviously, you look at probably volatility at all the different asset classes, but
right.
Yeah.
And
So,
what are the sectors or subsectors that are performing?
yeah.
So if you think it's a quad 2 and for the last 2 weeks you have staples and utilities leading the pack, maybe there's something going on.
Yeah. It's a fair point. I think that's one of the unique challenges that I face too, is you look at the numbers and you can see the direction is coming, but I always like to sell at the top and buy at the bottom. So it's hard to do that because the kind of that macro setup doesn't really allow you to, because the signals come and you have to adjust on the way down. So how do you think about sizing? So hypothetically, you go to 6% position. Do you bring that in over little pieces and then you piece it out on the other side, or how do you think about that?
Generally I build it up in pieces.
Okay.
And maybe a name at a time or a couple names to build up technology, for example, or it's more of a process moving rather than it's Friday and we're going to do wholesale changes.
Yeah.
Sometimes I guess you have to, but so far I really haven't experienced where you've had to move like 10% from here to there in one day.
Sure.
We've done, maybe 3 to 4% in one day.
Yeah.
Even that's big enough though. Like that's a significant move. If you move, say 3% from energy to utilities, that's a big call.
Yeah. Because if your timing's wrong, it's gonna drag on your performance.
Right.
Yeah. And so I see that as I look at your portfolio, you got a lot of individual names, but then it looks like from a bond perspective, do you only use ETFs when you put bond exposure on, or how do you think about that?
Yeah, so that changed in the last month.
Okay.
And the main reason is, I guess it adds to the MER. And
Okay.
really, uh, we're of a size now where we have more clout on the institutional bond desk.
Okay.
So we can, it used to be when we were small, they said, oh, you need 10 million to do a bond trade with us.
Okay. Yeah.
And now that we're big, they say, oh, no, all you need is $1 million. It's like the rich poor guy, right? When you're
Yeah.
poor, you need a big account.
Yeah.
And then when you're rich, people do anything for you. Like,
Okay, so you trading the individual bonds now.
right.
That's fair. Okay. Um, I think what I noticed anyways, March of last year, like there was a big discrepancy between where the underlying bonds were trading in some of these ETFs. Like the Canadian government bond XGB was trading at a huge discount. Um, have you noticed how things have evolved with the bond market and bond ETFs? Has it changed a lot in your view? Do you think about that?
Um,
No.
Personally, no.
Hmm.
But I mean, advisors would tell me that, don't you think there's a risk with holding these things?
Yeah.
And at the time, I guess I didn't, it was what was available to us. So I really
Sure.
had no choice but to say,
Yeah.
we're good to go with these things. But
Yeah.
now we've made the move
Yeah.
and we don't have any bond ETFs.
Fair
And
enough.
it's easy.
Yeah.
I can click a trade in, you know, 30 seconds.
Right. Yeah.
Like it's
Simple.
just, I'm so slow typing it in. That's why I take 30 seconds. But
Yeah. Fair enough. So I guess from just from a positioning perspective, and I think we've Keith has talked at length about this potential quad four that we're going into, but it seems like maybe it's going to be fairly exclusively North American growth and inflation slowing together. What do you think about how it looks like Europe might be okay? Looks like their growth and inflation might be in line. How do you bring that in? Because presently, most Canadians are heavily weighted to Canada with a little exposure to U.S. and maybe global. If you're thinking as an average Canadian, how do you think about how to protect a portfolio where we might have a slowdown here, but the rest of the world might continue to grow? How would you think about that?
yeah, so we got his latest update, and these aren't his words, but he has Canada in a quad one, and he
Okay.
has Europe in quad two. So those are both markets you'd want to be in. And
Okay.
so we're overweight Canada, like everybody else, and we have a little bit in Europe. And
Okay.
China is still a quad three,
Mhm.
and the U.S. he thinks will be, despite the data saying in no definitive, like for sure, the data says it's a quad four, but he
Yeah.
believes it'll trade like a quad three.
Okay. Okay.
So I kind of think, okay, well, if you have the two biggest economies trading quad three ish,
Yeah.
are the other economies really going to trade like one and two?
Yeah. Probably not.
Probably not. It's my opinion. Yeah.
Yeah. Yeah.
So I think it's a pretty tricky time at the moment.
Yeah. Yeah.
So if we forget about Keith for a while,
Yeah.
every 111 days, the market usually experiences a correction of 5%.
Okay.
We're well over 130 days now. One argument could be every month we've been experiencing a 2 to 3% correction this year, but
Yeah.
then it goes back up. So maybe
Yeah.
we don't get that. Maybe we've been doing this back and forth and really rotating,
Yes.
right? We've had a lot of, the meme stocks in February, then they crashed,
Yeah.
and then the Bitcoin's gone up and crashed.
Yeah.
The meme stocks have come back,
Yeah.
and last week, we had the materials, financials, and energy stocks go down 6% in like 3 days.
Yeah.
So maybe we're getting these ongoing corrections.
Yeah.
And that this quad 4 that apparently is in the data is not going to be really quad 4. It might be more of a quad 3, and it might be more quad 3 globally.
Right. Yeah. Yeah, so that's important for sure from a construction perspective, and that's why you want to own certain things like gold, maybe, and gold miners potentially in that backdrop. And yeah, your point. I mean, you look at some of the names, like maybe some of the other higher growth ETFs, like some of Kathy Wood's ETFs, are down 30% this year. So you're getting some of that cycle maybe already happening. So maybe the damage is done in some of those places, and they don't feel as much drawdown from these levels. And tech definitely has bounced back here. How does tech typically trade in that in the quad 3 environment?
Yeah, so glad you mentioned that. So in quad 3, the best two sectors are energy and technology. So energy picks up on that inflation theme, and technology, that long duration. If the economy or GDP is rolling over, then you want to buy stocks because growth becomes scarce. You want to buy those growth stocks.
Right. Yeah.
So that's what we've done recently is our number one weight is healthcare, and our number 2 is technology, and our number 3 is energy.
Okay. And technology, do you buy the individual names, or okay. Yeah.
So they're names you're going to know. We don't
Yeah.
like Adobe and Microsoft, Salesforce, stuff like that.
Yeah. So how do you get your mind around coming from a bottom-up environment where you think about valuations, and this kind of maybe, like at least I know that I had this kind of upbringing. I thought about valuations, like I kind of grew up thinking about price earnings and multiples and cash flow and these kind of things to the levels we're at today where maybe they don't matter to the same degree. I mean, at least it looks like they don't matter at all, but maybe they don't matter to the same degree. How do you get your mind around that?
Well, that's what I was going to ask you is, does that work? It doesn't seem to work. And I think what's happened over the last 20 years is factor exposure has become the nomenclature, as they say, where I want to have exposure to low beta and dividend yield and blah, blah. And so this is the basket, the 20. And so we're on the Goldman Sachs platform, and they have all these different baskets.
Okay.
You just have to, I want to do this today. And it gives you 40 names, and it has the characteristics that you want. It's not about...
Interesting.
Does this trade at a 10 PE and 4%? It's just all part of a basket. And I think the rise of the ETFs in the 90s and more recently has brought this about.
Yeah, that's fascinating. I mean, you talk about this like everybody's doing this, and maybe everyone's doing it in the U.S. and like we say Goldman Sachs, but I talked to 100 other portfolio managers in Canada, and I don't have too many conversations like this. So, you don't. There's not a lot of people that I'm aware of, anyways, in Canada that kind of think this way. Would you agree?
Yeah. So let's get to a Canadian name like Shopify.
Yeah.
Who bought that name and who hung on to it? The growth managers.
Yes.
Why? Because it's not because they're making money.
Yes.
It's because of the growth factor. They're growing revenue.
Right. Yeah.
And so that's the number one factor they look for.
Sure.
So boom, they put it in. And, I know a lot of people that sold the stock at 160 and thought it was expensive then.
Yeah.
And now we're 1,800 or something.
And it's more expensive now.
Yeah. But the question is, who is right?
Yeah, no, I mean,
the guy who hung on.
Of course. Yeah, yeah. I mean, how do you make money? And I think ultimately that's the evolution that I had anyways, is that you have to adapt to what the game is and what is, your objective is to protect and grow money for people. With the thinking around, you have to adjust to what the market is doing. And so, I think it's a fair point that valuations are something to think about, but it doesn't necessarily impact the direction of the stock. And this continued focus on passive, right? Money's flowing into these passive vehicles, and I don't think that's going away anytime soon. What do you follow any of those numbers around where money's going, fund flows, things like that?
Not too closely, but I think this is all a product of the central bankers, really.
Yeah,
Ever since the great financial crisis, rates just went to zero,
yeah,
and they try to raise rates, and the market crashes, so
yeah,
they send rates to zero again.
yeah,
And so again, these technology or growth names become like a long bond. It's that long duration trade,
yeah,
and that's how they're treated.
yeah.
And so it's we never bought Shopify. So it does. A lot of these things don't really sit well with me
Yeah,
because they're expensive. But if you wouldn't have bought into the market last October if you went by those valuations. Market's been expensive for a long time.
yeah, yeah, yeah. Yeah, and if rates are pinned at zero, if this does become Japan-like, where rates, I mean, yield curve control, all these other things come into place, which I believe is probably likely,
Yeah.
then, valuations need to be adjusted upwards, and they continue to mean a little bit less than they would have maybe in the 80s. So, as you think about all of these things coming in, I guess this challenge is continue looking for good names and good ideas. When when I guess valuations continue to be stretched and you're looking in certain sectors, how do you think about stock picking? And say you like healthcare, how do you go about deciding whether what's the components of what makes a good company for you?
Yeah. Um, I guess I'm still a bit old school and trying to look for some valuation. So I guess I tend to have a bias towards value or cheaper names.
Sure.
And then if I go for more, up and coming names like a Zoom or whatever,
Yeah.
I'll do 20 basis points there. Where General Electric, I can buy 1%.
Right. Yeah. Yeah.
It's just my level of comfort. But I could buy 5 Zoom type names to counterbalance.
Yeah, for sure. Okay. Interesting. And did you participate in any of the SPACs? Have you bought any of those names before? Any thoughts around SPACs and how they work, and thoughts around if they continue to be a way for companies to go public?
Yeah, we dabbled a little. I think at one point we had 3 of them in the portfolio, and again, it didn't amount to much, about 60 basis points.
Yeah.
Again, I just never trusted them, and I guess I was right because they came apart at the seams.
Yeah.
But they were working. Some where you buy it at $10 and then they're 25. Like,
Yeah. 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 I mean, some of them, I guess I would ask you though, some of these are the ultimate small caps though, right? Some of these businesses that come out,
yeah,
they're kind of quasi venture capital.
right,
Yeah.
yeah. So again, as you become a bigger fund, it becomes more
Can't
difficult
buy
to
them. Yeah.
buy them and stay with them.
Yeah. Yeah.
Yeah, so it's not really my cup of tea these days.
Yeah, for
But
sure.
having said that, we hold things like Acquisitive Technologies. It's not a SPAC, but some small cap tech in Canada,
Okay.
because Canada's known for having good small cap tech and small cap healthcare. And over time, they get taken out, and you can get some good premiums.
Yeah, for sure. For sure. What,
I got one there
sorry,
for you.
go ahead. Yeah, go ahead.
Yeah, for sure. You mentioned briefly Bitcoin before, and being a macro guy, one of the biggest macro influencers is Raoul Powell from Real Vision. I don't know what, I mean, he's obviously been probably the most bullish and the biggest influencer in crypto over the last 12 months. Where do you think that fits? What's your overall outlook on crypto and Bitcoin and how that all fits in to the macro view?
Yeah, so we bought some in around November, and we
Mm-hmm.
sold it in February. So we didn't get the top, but we made money on it. And then I just felt the volatility, and it was something that, it was never going to be a big weight. It was more
Yeah.
an opportunity. We played that opportunity and left a lot on the table, but we made money.
Yeah.
Yeah.
And I know currently at Hedgeye, they think it's in a downtrend.
Yeah. Yeah. Yeah, so so I guess the long answer is you'll use it again if it gets into your view around, like if the stars align, you would bring it back into the portfolio at some point.
Yeah.
Yeah.
And I would say what we do is if there's something hot or new,
Yeah.
we tend to want to participate. But again, it's not going to be 10% of the portfolio. It's going to be some sort of small percentage. So again, in 19, in 2018, we were buying a lot of the weed stocks.
Okay. Yep. Is there a ribbon?
And in Canada, that was the only stuff making money.
Yeah. Yeah. Yeah.
And so
So
we're open-minded to new ideas.
yeah, for sure. So when you participate in Bitcoin, what do you buy? Like, how do you participate there? What flavor? Like ETF?
Yeah,
How'd you participate? ETF?
yeah. I think it was the XBTC, the one trading in the U.S.
Okay. Yep.
Yeah.
Okay. Yeah. Yeah, no, it continues to be. I mean, Canada, obviously, we're the first to launch an ETF in the world, and the US
Mm.
continues to still be able to be challenged on it for getting an ETF passed. So I know that'll be interesting to see how that plays out. Do you follow RAL at all? Do you follow any of the Real Vision research that they do?
I don't think I've been on one lately, like not this
Okay.
year, but
Yeah.
I've seen them a couple times over the
Yeah.
years.
Yeah.
Well, yeah, this year it's been pretty crypto heavy, but they seem to be headed back more to the overall view.
Yeah.
Yeah, for sure. I mean, interesting. Definitely a creative macro mind, but he's a, we'll call it 3+ years macro thinker. So kind of got a longer term view that he
Right.
takes. Yeah,
Right.
yeah. So it's
For sure.
but obviously interesting. So do you use other sources for information, or do you use the macro and then from there you and your team come up with the ideas? Or is there other pieces of research that you use that you think is interesting that people should look at?
Well, we use another outfit called Cornerstone Macro,
Okay.
and I would say their economist is very good,
Okay.
Nancy Lazar, and then they have a strategist who gives a lot of information.
Yeah.
His accuracy is, it's okay, but what I learned over the years is there's strategists and economists who sort of just give you the facts.
Right.
And Keith is really the first one where I've seen these are the facts. This is what you do.
That's how you execute. Yeah. Yeah.
Yeah.
Yeah.
Whereas not too many are able to do that. Most of them just regurgitate really the data that comes out
Yeah. Yeah.
and no interpretation.
Yeah.
Or the
I mean,
interpretation isn't related to the market. It's not related to, you know what, you should be overweight the long bond and
yeah.
underweight gold, whatever.
Yeah, they have very linear thinkers.
Yeah.
And so a lot of times they strip out this, strip out that, forecast, years out into the future, which the market doesn't care about. Yeah. I mean, I would agree. I think he done and does a good job of that. But what I also found, kind of to your point, which you talked about, kind of touched on early, is that you still have to interpret it, and you have to still decide when and how you're going to construct that, because it might not align exactly with what he's thinking. The challenge and the unique that you provide is interpreting it as it's coming and then constructing the portfolio based around that, right?
Right. Yeah. So, like for himself, he views it basically day to day.
Yeah.
So he gives you ideas of, buy Pen Gaming,
Yeah.
and he'll pay $78, and then tomorrow he's selling it at $78.25 and calls that a win. Well, it's not really a win for me.
Yeah.
Sure, the commissions are so low these days that you make money, but
Yeah.
I'm not doing that.
Right.
So we're just, from him, basically, we want that big over the interpretation of the big picture.
Mm-hmm.
And then they have a suite of analysts that we get ideas from.
Yeah.
But I mean, it's fairly niche-y,
Yeah.
so it's not enough.
Yeah.
And so we have other sources. Some where we just pay for the research, and some, are brokers.
Yeah. That provides you the analysis.
Yeah, but again, not to criticize analysts. They're usually good at giving you the facts, the information, but not how to trade the stock.
Yeah,
Or
buy
when
it.
to get in, when to get out.
Yeah, exactly. Have you found any?
Or is this the environment to be buying that
Yeah.
green stock type of thing?
Yeah. That's a great point. I mean, certainly it's something I learned early on as well, is that, you get analyst revisions after stocks rallied 20%, and you get revisions down when stocks have dropped 20%.
Yeah.
So, but maybe you kind of touched on briefly there, have you seen ESG start to play a part in thinking? Obviously, right now, the sectors that are doing well aren't very ESG friendly, but have you seen this play in at all? And do you think about that at all?
It's not something that is at the top of our list, is making our selection.
Yeah.
But I think as time goes on, it will become more and more important. All the companies are putting more of an effort to be ESG friendly.
Yeah.
So the fact that that's happening is kind of one of the reasons why you don't need to really focus on it too much, because someone else has put the pressure on for these companies to improve their ESG scores. Mm-hmm. But apparently there is some correlation. If you can get your ESG score to go up and to the right, then your stock price will follow.
Yeah, and certainly it could be the case. I think it's going to play a part. I mean, obviously Thompson and Bloomberg and all these different sources are providing the analytics now, and so I think it's definitely starting to come there.
Yeah, we use Bloomberg, and if someone said, "Well, what is your ESG score on your portfolio?" I'm pretty sure I can get it.
Yeah.
For every company.
Yeah, and that'll probably evolve. If you could put your small cap hat on and you could look multiple years into the future, is there anything that you see, any asset class maybe, or any sector that you think could do well over a multi-year time frame? I know it's taking you away from what you do every day, but
yeah. So I think with rates as low as they are and likely to stay low for a long time, I think people will be forced to continue to be in the equity market.
Okay.
And so I think technology will continue to do well because it provides growth. Mm-hmm. And I do think materials and energy will do well too.
Okay.
So with the move to wind and solar and all that stuff, to make that more economical, the an oil price at $40 will delay that move.
Sure.
An oil price of $100 will make that move happen quicker. So I think oil prices stay high.
Okay.
And what it reminds me of is in, I think it was 2013, the semiconductor industry went through a big consolidation. And so then all you had was Hynix, Samsung, and Micron. They're 70% of the market.
Yep.
If you look at what's happening in Western Canada, you see it every week. The fewer and fewer companies, more M&A.
Yep.
Consolidation.
Yeah.
I saw like Ensign, I think, bought Neighbors services in Canada.
Yeah. Yeah. Yeah, and see Pembina and Interpipe are trying to merge, or Brookfield, somebody. But yeah, interesting. Yeah.
So that'll make those the remaining players strong and have pricing power, I think.
Yeah. Interesting. And yeah, I guess if we, you say materials, I guess that'd be copper, lithium, those kind of, spaces could do quite well over the longer term. I think that there hasn't been a copper find in a very long time, I believe.
Yeah, and what's out there is junk.
Yeah.
Right? It's going to have to be these huge open pit mines.
Yeah.
So, yeah, I think, we all want to get to this electrification, but we might have to use old copper, like reusable copper, from somewhere. I'm not sure that there'll be enough new mines mined, especially when political change happens as well.
Right.
Peru and Chile, the workers want more.
Yeah.
And
yeah.
So again, Canadian assets will probably be of more value in time.
Sure. So do you think that inflation is kind of an ongoing potentially issue?
Yeah, this is the $64,000 question.
It certainly is.
And how to position. So yeah, does inflation stay high? I think it kind of stays high this year.
Yeah.
Again, using the HEDGI numbers.
Yeah.
Staying near 4% for the balance of the year.
Sure.
But I think if we look till this time next year, it could be back to 2%.
Yeah. Okay. Yeah. That's fair. I would tend to agree with that. It looks like, and technology is inherently deflationary. So, I think be hard to contemplate $150 oil in 12 months as well. While possible, not likely.
And I think the wage, like everyone's worried about wage pressure. Yeah. And I'd say that's true in sort of the services like restaurants and hotels and stuff.
Yeah.
But all of a sudden, like if you're looking for a software engineer and you need them in Ottawa, well, why not get the guy that's in St. Louis? He doesn't have to leave his home now.
Right. Yeah.
Or get the guy in Flin Flon, Manitoba. People can work remotely. Yeah. That's what I think everyone's found out is that this does work.
Yeah. Yeah, I think you're right. I mean, the Salesforce is talking about giving you the option, right? You can work from home, but you take a pay cut. And I don't know if you caught any of Neil Howe's research today saying that, people would, especially in the financial space, they would, likely consider moving if they don't have that work remote option available to them.
Right.
Yeah.
I didn't catch it, but I'll take a look tonight.
Yeah. No, he just talks about the fact that, people want to continue this, and, you got to think that it's not going to cause big pay increases.
Yeah, well, if I was younger and my kids were young, I'd say this would have been great. You can walk your kids to school. It's only like the school is 10 or 15 minutes away, and everyone's allowed a little bit of a break. So and then you're not spending that commute time.
Yeah.
Yeah. So
well, if you ever call Ben during the day, you'll hear the Ben Hart public school going on in the background. He's the teacher and the principal.
Exactly. Scott likes to call at lunchtime and see what we're having for lunch.
I do. It's always stuff that you feed an 8-year-old. Hey, we're having craft dinner. We're having hot dogs.
Yeah, no, so I'd agree with that. I think it's a fair point. Is there anything else that you think people should know about investing, or where they should look, or anything that I didn't ask you that you think I should be asking you?
Um, I think, not to toot our own horn, but
Hmm.
I think it's a pretty good product where, if you have $1 million or more, maybe you want to have your money managed separately. But if you have like 25,000 in a TSFA,
Yeah.
we're an asset allocation fund in reality.
Yep.
And as I said, the reason I signed on is I want to try to make money in all time frames.
Yeah.
Now, if market goes down 10 and we go down 2, I consider that a win.
Yeah.
If market goes down 10 and we go down 8, I don't really consider that a win.
Yeah. And
And our metrics, what we're trying to do is capture 80% of the upside
yeah.
and only 20% of the downside.
Yeah. 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 Listen, I agree, and that's what initially got me interested in what you do and how you do it. I think you've done an excellent job at that. And I don't think, as I've looked across Canada, I don't see many competitors that have the same philosophy and the same type of thinking. You bring a kind of a hedge fund type of process and strategy in a regular mutual fund. So I do think you've done a great job, and it is very unique. And so, I applaud you, and I appreciate you spending the time talking to us so we can, answer some questions and share it with my clients and on my audience. And so I really appreciate your time. And is there anything else you want to add? Let me know. But I think it was awesome.
No, it was fun. Thanks for having me on. And yeah, let's hope if there is a correction, it's not so deep.
Absolutely. Scott, was there anything else you had for Ted?
No, I think that's it. Thanks a lot to Ted Whitehead, and thanks for everybody for tuning in. We'll see you next time for another episode of Think Heart.
Awesome.